On today's show, is this the start of a market crash? Joe Biden is the poorest member of Congress. Should you buy the 10% Nvidia correction? And should we expect a Santa rally to end this year? We've got a lot to talk about. Let's roll the tape. Welcome, everybody, to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks on Tuesday fell, with the Dow Jones on track, logging its biggest losing streak in 46 years. 9 down days in a row, and it was a pretty brutal day across the board. Red almost everywhere except in a couple of places. We saw healthcare, drug manufacturers, they were fairly green across the board, led by Johnson & Johnson and AbbVie. However, on the flip side, healthcare plans led by United Health were very in the red, following the broader trend of the market. Tesla was up about 3.5%, continuing its momentum, really leading the charge, along with Apple and Microsoft. Those three were the only mega caps in the green, sort of softening the blow in the market we actually saw today. And semiconductors, AVGO, after 40% run in 5 days, we saw a 5% pullback. Nvidia fell. Financial saw very red trading, and that was the trend across the board today. Apart from a couple of outliers like we just mentioned, red across the board, and only one sector gained, the discretionary sector, up 0.18%. The SPY, the S&P 500, fell 0.56%. A very ugly day, especially for an index. That's a pretty ugly day, down 0.56%, especially for the S&P 500. Every sector lost today. Energy continues to be a dumpster fire, continues to be the worst performing sector for this week and for the last month, even beating healthcare, which is crazy, down 1.16%. And that has to go with what Trump's doing. Energy falling is actually positive for Trump because he wants to, quote unquote, drill baby drill, and that's going to lower the overall price of energy, and that's why we're seeing energy stocks fall in the way they are. Industrials were down 1%, financials, technology, comm services. Guys, a brutal day across the board. Large caps, small caps, mid caps, value and core actually really taking it on the chin. And all things considered, we actually saw large caps outperform the smaller parts of the market by a pretty wide margin. And we saw, this large value trade really put on a show today in terms of outperformance to the downside. And it was quite simple when you actually look at what's in that index. It's a lot of the healthcare names that sort of like outperformed today, and that's why we saw less selling in this part of the market. However, all in all, it was a brutal day across the board. And what we're starting to see now is some of these longer term averages really faltering, particularly the 50-day. And this is where we need to start actually getting a little bit concerned, because now that the shorter term averages sort of moved to the downside, and the 20-day, the 5-day and 20-day, and we're seeing movement here in the 50-day, although it's just below the 50% mark, that really does open up the 100-day, 150 and 200-day to lose their averages. Now, these still look very much intact, and that's why I'm saying longer term, if we look past the first and second quarter 2025, I think you're going to see great opportunities, and we should be higher than where we are right now. However, these medium term trends are coming under pressure, and that's something we do need to watch, because if this continues, if we continue to see the selling and the churn under the hood, gonna really hamper market returns in the month of December, and then we could actually start to see that market correction come a lot earlier than anticipated in 2025. I was looking for a decline after the inauguration, but we could be seeing that right now. So we're going to monitor the market every single day, and we're going to keep an eye on breadth and what the market's doing, because that's going to really tell us everything. Maybe everyone's front running a crash. Maybe the inauguration is actually a buy opportunity, but we'll see how things pan out. Look, markets right now, the S&P 500 isn't falling apart. We're seeing some weakness in a seasonally strong month after a very strong year. And there are some underlying problems that's causing that. However, all things considered, I still think this is great opportunity because the market is still looking very constructive, especially when you zoom out, all things considered. Now, what really dampened sentiment today was the Dow Jones. Now, the Dow had its worst losing streak in nearly 50 years, and that was led largely down by two stocks. The first one is actually United Health. It was down 3.76% today. That was coming off yesterday's 3.5% loss and a 2% loss the day prior. And there's just a ton of negative sentiment behind this. The CEO was assassinated. That didn't help sentiment. The investor day wasn't that great. There wasn't a lot to love right there. Trump's nomination with RFK, as well as the overall momentum fading in healthcare, and United Health is leading the pack lower because it's in a lot of ETFs, it's in a lot of portfolios, and our fund managers are selling this name. And as a result, the stock is down 19% in the last month, peak to trough. A very crazy move. It is actually getting to an attractive level. I've been doing a bit of due diligence on this, but nothing too crazy. By the way, healthcare is one of my top picks for 2025. I think the healthcare sector will do very, very well. I think United Health can actually be one of those picks, but you do have to get past this near-term downside negative sentiment and volatility, and the stock probably will go lower. I wouldn't be surprised if we saw 470, 465 in this name in the next 2 to 3 weeks. I think momentum is clearly to the downside and do expect that to continue. Another benefactor to the Dow's decline today was actually Nvidia, down 1.72%. The stock dipped nearly as much as 2%. On a peak to trough basis, the stock is actually down 10%, signaling a correction. Now, Nvidia set a record high in November, and despite its rapid rise as a leader in AI chips, concerns are starting to make its way to the top, especially with slowing AI spending, production delays, increased competition from Amazon, Broadcom, as well as Blackwell overheating issues, coupled with an antitrust situation happening in China. All of this has added pressure to the overall stock price. We have seen Nvidia actually correct 10% in the last number of trading sessions. So somewhat of negative sentiment brewing here, but when the stock is up 180% for the year, sometimes you want to just take profits at the top. Let's assume Nvidia does $5 in earnings per share, right, for 2025, $5 in earnings per share. If you apply a 30 PE multiple to that, which is not crazy for the greatest stock in the world, the most important stock in the world right now with like insane demand. If you just apply a 30 multiple, right, the stock should trade at 150 2025 earnings. And I don't think a 30 multiple is that crazy. Apple's trading at 42 right now. Microsoft's trading at 35. Tesla's trading at like 90. Amazon's trading at like 54. So look, Nvidia, not a crazy forward multiple if you just apply $30 to $5 in earnings per share. And earnings are probably going to come in closer to $5.20, $5.30. Take that as you will. So opportunity here is to get long if you think Nvidia can hit those earnings per share expectations. Now, what did soften gains in the market was actually Tesla. Tesla is now less than $100 billion away from eclipsing the market cap of Facebook or Meta, and it continued to enjoy a massive rally here today, up 3%. Absolutely crazy. Probably going to break 500 before the end of 2025. Absolutely insane. Extreme alpha and outperformance when the market declined, and that's because MyZero actually upgraded this name to an outperform with a price target of 515, and the upgrade just cited looser regulatory framework expected in 2025 following the relationship that Elon Musk has with the now president-elect Donald Trump. Now, for all of the negativity we saw, what also didn't help sentiment towards the end of the trading day today was that Biden actually came out and said he actually supports a ban on congressional stock trading. That is absolutely crazy, guys. Can you believe that? He came out and said that. The president also reflected on being ranked as the poorest member of Congress as Trump, a multi-billionaire, returns to the White House. So the current sitting president coming out and saying he supports a ban on congressional stock trading, that's not a good look. That did hamper sentiment, but all in all, it was the other factors that I just mentioned. And then looking at economic data today, guys, November retail sales came in. They rose by 0.7%, beating Wall Street's expectations, signaling strong consumer resilience and a promising start to the holiday shopping season. Guys, October's data was also revised up 0.1% to 0.5%, and gains were driven by a 2.4% jump in auto sales and a 1.8% rise in online retail sales. That's month over month, by the way, guys. However, sales excluding autos and gas rose only 0.2%, missing the estimates, while the GDP-linked control group matched expectations with 0.4%. So all in all, retail sales came in as expected. We also saw business inventories came in as expected. And at the end of the day, for everything we're seeing, the economic backdrop, the macro, continues to remain very robust. Let's hop on the charts. And equities had a very ugly day across the board, but it wasn't just equities. It was virtually everything. It was a liquidation event today, and we could definitely tell today there wasn't a rotation. It was just a liquidation. It was get out of equities, get out of risk assets, and just hold some cash, because we saw the S&P 500, the Nasdaq 100, the IWM all fall with higher beta, higher risk, small caps, Russell 2000 falling the most. And we actually go down here to the yield market, right? Yields actually fell. The 2-year, 10-year, and 30-year yield, they actually fell on the back of stronger than expected economic data. And what did we see? A rise in the dollar. So people sold equities, went to the dollar, went to cash, and bought bonds, right? Look at the TLT, look at the AGG. Relatively speaking, they outperformed equities as a whole. So we saw pretty much the market go from risk assets into bonds, into cash, into sort of these safe haven assets. And investors didn't even want to deal with commodities. Gold fell 0.3%, and then silver was pretty much flat. Crude fell 1.3%. So today I would classify as simply a liquidation, and then money did sort of go into Tesla, cash, as well as bonds for yields. However, I still think all in all, equities look very constructive. I'm not of the camp that this is going to fall apart. If you look at the S&P 500, it's sort of just trading flat. That's all we've done for the last couple of weeks, just digesting a lot of the gains we've had in the last month, 6 weeks. And yes, that has been coupled with bad breath, because you look at something like the RSP, it's actually fallen for 11 days in a row. That's definitely notable. But when you look at the S&P 500, the majority of investors, this index sort of just trading flat. We've had down days, we've had up days. Such goes the market. And if we actually have a look at the 5-day swing model for the S&P 500, like our gamma flip zones, but sort of in the middle here, and you can see when we touch the lower band, we can sort of move up. When we touch the upper band, we can actually somewhat pull back to the lower band, but right here in the middle. So the market is still assessing all of the market, all of the incoming data to determine what we actually should do in the S&P 500. And that's all I can say we're really doing. All we're really doing is just digesting a lot of the move we've seen here with the Trump trade. And as a result, the market's just moved into the mega caps, higher quality names. That is the S&P 500. That is the Nasdaq 100, the tech index. And they've moved out of the broader market, right? The RSP, as well as small caps. However, I still think everything still looks really, really constructive. Okay, the RSP, not that constructive, but we are still holding this low right here. I mean, we're at this low. We should find support right here and move up. If we do that, we could say that's an equal low relative to this low right here. However, if we continue to move down, there will be a lower low, and then bears will really need to put in the work. However, when we look at the RTY, things still looking very constructive. We're still finding support here at the put support. Like, we haven't really broken down. We did dip below the put support ever so slightly. However, the bulls did come in, take us back into this negative gamma territory, and we're still holding this low right here. Now, it is truly up to the bulls to really hold this level, because if we start sliding below here tomorrow, things are gonna get ugly. But right now, in the here and now, things looking constructive for the RTY, at least for a low to be put in here. Look, this is what you want to see. You want to see consolidation at this level, at the put support. With the S&P 500, things are still in positive gamma. We haven't fallen apart yet. And even if we do move to the gamma flip, that will be normal, and we want to buy that dip. With the Nasdaq 100, very similar situation. In fact, yesterday with the Nasdaq 100, we actually came out and said that we actually do see downside, because we did hit the top of the range, and that's exactly what we're seeing right now. So we did see a little bit of downside from the top here. That has led the entire market to actually fall. But all in all, guys, I think equities still look very, very constructive. Large caps look very, very constructive. I think the RSP, great opportunity here. I see the RSP moving to 200 in 2025. That's material upside from where we are. And I do think small caps outperform into 2025, but there are risk factors. I think the biggest risk factor is inflation. I was doing a ton of research into CPI, inflation, and overall indices, guys. And input costs when CPI rises is not really good for RTY. So when we get the PCE inflation and the next couple of inflation prints, we really need to see inflation moving in the right direction, closer towards the 2%. We don't want to see reacceleration. So that is the biggest risk factor right now. If inflation continues to do what it's doing, which is sort of like troughing out and move higher, that is not going to be good for the markets. And at that point, the markets can really struggle with that, especially because as a result, yields are probably going to rise, and that's further going to exacerbate the decline in small cap. So guys, the inflation prints over the next 3 months are absolutely key, particularly CPI. We don't want to see a reacceleration in the overall inflation rate. If that is the case, we may need to readjust some targets for 2025. But in the year and now, looking at large caps, looking at the S&P 500, things look really, really constructive. We can see the bulls have started buying the dip right here. We saw a massive rally here at the end of the day, moving upward. Now, it's still going to be a decline, still going to be a loss for the day. Nonetheless, this is a tangible dip that the bulls did buy, and we'll see if we actually get followed through in the overnight session into tomorrow. If we actually then go to the daily chart, we're sort of forming a massive wick here. We're still going to close red for the day. We close in a couple of minutes. But all in all, I think equities still look constructive. You do want to buy any dips we do get, especially if we do move to this gamma flip. But, we haven't had like these massive capitulation days like we would right here. We've had down days, yes, but we're sort of just trading in this range. I think equities look constructive. The headlines look brutal, 46 years, never a bigger loss in the Dow Jones, 11 down days in the RSP. I think it's all noise. I think we're going to move higher into the end of the year. That can all change at a dime. So guys, go ahead and actually hit that subscribe button so you don't miss a beat, because we will adapt to market conditions. Nonetheless, I am still expecting somewhat of bullish momentum to the core resistance. That is always the plan we trade for the S&P 500 into the end of the year. I think we're really going to see material downside in the S&P 500 closer to the middle of Jan in that February time period. So until then, continue to buy these dips, guys.
And let's talk about sentiment. This is Goldman Sachs Sentiment Indicator, which measures stock positioning across retail, institutional, and foreign investors. And this indicator ticked down to 1.6% from the week prior. We've seen a huge downtick in sentiment in a seasonally strong December, which often sees a Santa Claus rally with year-end momentum driving gains. And this dip in sentiment is actually constructive, signaling the markets aren't overly euphoric right now, particularly when you look at breadth metrics, leaving room for upside. Historically, moderate bullish sentiment aligns with the very steady gains, especially when the seasonal trends are on your side, like they are in December. And investors should maintain a positive outlook while monitoring economic activity, economic data, and earnings updates that may shape the overall landscape of the market. And the weight of evidence scorecard currently sits at neutral, reflecting a balanced risk-reward environment for investors. And while this does suggest neither bullish nor strong momentum, it aligns well with the current sentiment backdrop, providing a foundation for potential upside during the month of December. A neutral scorecard indicates that market conditions are stable. And if you actually look at the weight of evidence scorecard, we see fairly bullish momentum, except in market breadth, something we've seen with the mega caps leading, as well as sentiment, something we just spoke about. But if you look at the global macro, this is really weighing on the overall market. In other words, if you just remove the global macro, right, and just use US stocks, things are actually sitting between neutral to mildly bullish, especially with the weight of evidence. In other words, if you're holding US equities, expect us to simply grind higher into the month of December, and seasonally, that's what we normally see. This is S&P 500 seasonality in December. This is where we are right now. We normally put a bottom in here, the middle of December, 15th, 16th, the 17th, and then we rock higher. That's what we saw yesterday. We saw somewhat of a continuation today, and do expect higher prices and linear returns throughout the month of December, now and even into the end of the month. And this is something that we normally look at, probably we'll start looking at towards next week, but something I want to bring to you guys' attention. This is the Santa Claus rally, the last 5 days of the year and the first 2 days of the new year. One of, if not the most bullish 7-day periods in the year. Average return 1.36%, median 1.35%, with a win ratio of 87%. And normally this is a very, very bullish time period of the year. You want to remain bullish, you want to remain constructively long, because this is a bullish time period and it normally leads into the flows we see in January. But we are about a week away, so do expect momentum into the month of December. We have seen momentum momentum in the mega caps, not so much the broader market, but do expect a turn and do expect us to rally into the end of the month, at least according to seasonality, guys, coupled with the Santa rally that we should really see if history is anything to go by. But all of this will depend on the macro, and right now, the macro is looking really, really good. The US economic output hit its highest level in nearly 3 years, led by services business activity or manufacturing services that hit 56.1, with the composite, which is a combination of goods and services, hitting 54.9. Very, very bullish momentum. Now, we are in an overall goods recession, services keeping us up to par, meaning the overall composite output is above the 50 level. Readings over 50 show growth or expansion in the US manufacturing sector, and that's what we're seeing right now. And for those of you that don't know, manufacturing services is sort of like if a company was to construct an airplane engine, and then the goods output is sort of like the company that would manufacture the steel to make that aircraft engine. So they go hand in hand, but I think services is more important in my opinion, and that's why we're seeing the composite PMI rally. All in all, US economic output looking very, very robust. This is exactly what you want to see, and this right here is consistent with a 3% GDP that you normally see in the US market. So do expect robust economic growth into the fourth quarter, into 2025, especially with the consumer spending during the holiday season looking very robust. We saw Black Friday weekend sales up 8.6%, very strong, and it grew at its fastest pace since 2021. You love to see it. And we also got this note here from BOFA. Hard data on Black Friday and Cyber Week spending indicate a healthy start to the holiday season. Nominal Black Friday weekend spending across Adobe's panel of online retailers rose 8.6% year over year in November, the fastest pace in 4 years, and pre-Black Friday e-commerce sales were also firm, though not quite as strong given the 7% year-over-year pace of economic growth in the October retail sales report. The Adobe data imply a sequential gain of roughly 0.8% in the non-store category this month. So, Bokla bullish on the overall market based on the data we're seeing right now. And talking about data, guys, tomorrow, Wednesday, we have the big one. We have the FOMC economic projections, the interest rate decision, as well as the overall Fed press conference, coupled with housing starts year over year, month over month, and building permits, the monthly and yearly figures as well. So a big week of data that's really going to shape the landscape going into 2025. We know we're going to get a 25 basis point rate cut. At least that's currently priced into the market. But what we really want to look at is building permits, because this really tells us, are rate cuts being felt by the housing market, especially the residential fixed investment component of GDP, and is that seeing an expansion? And right now, building permits, the forecast is for 1.4 million. Month over month, we want to see a 1.3% increase. Housing starts, right? We want to see a 1.34 million increase and a 2.3% increase month over month. So the market really pricing in very robust figures here for overall building permits, housing starts, which essentially is the housing market. And lower rates should start to be felt by the economy and the market starting to see an upward movement. So if we do miss, that's really going to affect retail stocks, financials, especially the Russell 2000 with a ton of REITs and financials in that index. So if we miss, expect high beta Russell 2000 to actually fall and pull back. The mega cap should continue and see flows go towards them. Nonetheless, guys, what's even more important than these figures right here is what we get from the Fed and the FOMC. And looking at data for the rest of the week, tomorrow, the biggest company reporting is Micron. But along with the housing data, we also have Lennar, both report after the close. And then before the open, we have General Mills and Birkenstock. Those are the big players in tomorrow's earnings. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.